we're seeing a dislocation in retail assets and retail assets pricing at the moment, where strong performing, dominant retail assets located within proximity of infrastructure, within growth corridors, is definitely priced in a manner that looks very attractive to us at the moment. We typically look at retail with the ability to introduce alternate uses, and retail assets at the moment we think represent very good risk-adjusted returns and compelling investment opportunities at the moment. I think there's been very much a flight to convenience-based, non-discretionary focused assets that have actually proven extraordinarily resilient during the COVID pandemic. Assets that have the ability to talk to their local community, to be the focal point, the town square of the local community, have traded exceptionally well over the last 12 months. That very much talks to the essential needs and the everyday needs that these assets have as a tenancy composition, anchored typically by a strong performing supermarket. And we as Elanor, with our highly active asset management approach, think there's an opportunity to acquire assets that are unencumbered, that have very favourably, are favourably zoned, and have an opportunity for us to ply our craft and strategically remix these assets into more everyday needs and essential needs focuses. We believe we have a market-leading capability in repositioning retail assets. We look through a very creative and innovative lens in how we look at an asset and its tenancy composition, and dare to be different in thinking that we can strategically remix alternate uses into that asset. Auburn Central was a prime example of an asset that we acquired in 2016 at a capitalisation rate of 8%, and through taking an active asset management approach, we were able to comprehensively remix that tenancy base away from fashion, jewellery, discount variety to essential needs, medical, health, food and wellbeing. And as such, we increased the sustainability of the cash flows of that asset. We reintroduced a tenancy mix that the local population and the local community were seeking. And in so doing, we de-risked that asset and divested to SCA in December of last year, and in so doing provided a return of over 24.5% to our investors. Clifford Gardens is a 9-hectare shopping centre that's located in a very prominent location on the two apex roads in Toowoomba, the Anzac Highway and the Warrego Highway. The site itself has a very strong two supermarket anchored tenancy composition, and also has a very strongly performing Big W discount department store. The asset's income is underpinned by those majors, with over 71% of the income being derived from non-discretionary uses as it is currently. Furthermore, over 91% of the income that is generated at Clifford Gardens is via national and ASX listed tenants, which talks to the resilience and the sustainability of the asset's cash flow. We've been very impressed with the support that we've thus far received from Elanor's capital partners. We've already locked in a 49.9% cornerstone investor who is a global institutional partner. The capital raise will see us raise circa $45 million, in which has actually progressed very well thus far. We've been able to secure debt finance for the asset from an internationally recognised provider at very favourable terms, which is really supercharging the returns on this asset such that we can provide over 10% per annum average returns over the hold period.